Good afternoon, folks, and welcome to the Lucas News Network. I'm Troy, your host, and as always, we have a great program lined up for you today. Dig out your winter jackets because we're heading all the way up to Canada for a special report on the Toronto Stock Exchange. We've reached out to our good friends at Jolt, who are based in Toronto, Ontario. They specialize in stock analysis, and they will be here today to explain some trends that they have been seeing. And, as always, they will present their two top picks. So a quick overview for our viewers on the TSX. As many of you guys know, the TSX has not been a strong performer over the past 5 years. The market is driven in large part by volatile energy stocks, and recent volatility in the TSX energy sector has decreased average returns. Over the past 5 years, the holding return on the TSX was negative 8%, with an average annual return of negative 1.7%. I know many friends and colleagues have been shying away from the TSX, looking to other markets that are experiencing stronger growth and returns. Here, joining us today with a different perspective, we have the team from Jolt. Go ahead, guys.
Hi everyone, I'm Rob Sanchez and I'm a senior analyst here at Jolt, and I've been with the firm for the past 6 years. My area of expertise is medium to large consumer retail. I'm a Western grad, BMOS alumni, and I'm very happy to be on the show.
Oh, thanks, Rob. Happy to have you on the show again.
Good afternoon, viewers, and hello, Troy. Thanks for having me on the show again. It's my 10th year at Jolt. I'm the Director of Mining and Research Exploration. I'm a Western grad and have been fascinated with gold since I came out of the womb.
Hi everyone, my name is Liam John. I'm a junior analyst here at Jolt, and I've been with the firm for 2 years. I've been spending my time in each department learning about various industries and companies on the TSX. I'm a Western University BMOS alumni, and it's my first time on the show.
So, Rob, tell us some things that you've been noticing lately.
Well, Troy, as you mentioned, the TSX is not performing overly well. Consumer spending has been up and down. However, some companies have been able to experience exceptional growth over the past 5 years. This growth has been attributed to cost control and smart investing. Some of these companies are likely to experience continued growth into the future as they have healthy financial ratios to handle the market fluctuations.
Wow, Rob, you have me intrigued. At this point, I think the viewers are ready. Hit them with your top pick!
Okay, Troy, for all the viewers out there, my top pick is Canadian Tire. Wow, what a performer. The company has 3 operating segments. We have retail, CT, REIT, and financial services. So the largest segment is retail. We have $11.3 billion in this area. This is a great company that Canadian consumers can value and trust. The average yearly returns for the past 5 years is 18.8%, and its overall return was 136%.
Wow, Rob, you are not kidding around with this one.
No way, Troy. Now let me look at some numbers here. So the company has shown exceptional growth for long term, with revenue growth rates of 3.1% and 5.75% in 2013 and 2014. Net income has grown at even greater rates than revenues, at 13% in 2013 and 2014. This indicates the Canadian Tire's ability to control costs with increased revenues. So we have current ratio and a quick ratio of 1.86 and 1.5 respectively in 2014. This shows Canadians' Tire's ability to pay off short-term debt. Based on my analysis, I don't predict any short-term financial difficulties in the near future for this company.
Well, Rob, that's interesting, but some of the viewers might be saying, tell us, why Canadian Tire? Why not something else on the TSX right now?
Great question, Troy. Now looking at the numbers here, Canadian Tire's correlation to the TSX Composite Index is 0.42. So this indicates a slightly positive correlation to the market, meaning that the company will perform better as the market improves, which we're predicting. Why not another company? Well, this stock is a low volatile returns and would be considered a low risk stock. Canadian Tire's beta is 0.56 over the 5-year period, indicating low market volatility compared to companies with betas over 1. Canadian Tire also has a standard deviation of 1.3 for its daily returns, indicating that investors will not experience huge return swings. People should be able to sleep easy with this stock pick.
Thank you so much, Rob. That sounds good. We'll try and get you back on the show in the near future to see how your picks play out. Vic, what are you bringing us today?
Well, Troy, my pick, Franco-Nevada. They're gold-focused royalty and stream company. This stock's been consistently outperforming the market the last 5 years, having average daily returns of 0.1% and 144% overall return over this time. This company is not leveraged, having only a 0.16 debt to equity ratio, and their correlation to the market is minimal, having a low beta of 0.36. Increasing gold and silver prices only benefit this company that's been growing in a poor market. So, even so, Franco-Nevada has shown that it can perform when the prices of gold are low, and they're taking advantage of companies that are struggling with this, acquiring them. So in my books, this is only a win that's going to grow with projected increases in gold prices in 2016.
Thanks, fellas. That's definitely some interesting picks. Let's hope for the best. Without going into too much detail, say an investor wants to diversify his portfolio between these two stocks. How would you recommend they split it up?
Well, Troy, that's a tough question, but our analysts came up with a solution saying that investors should put 70% of their equity into Canadian Tire and the other 30% in Franco-Nevada. This is done both comparing the TSX and T-bill yields, and we think that this is the best mix for them.
Very informative. Okay, fellas, I think that's that time. Let's hit the lines. All right, I know there's some viewers out there with some questions, so let's get to them. Okay, calling from Newfoundland and Labrador, we have Josh Iantuano. He is a war veteran, Purple Heart, well respected, and listed as retired. He invests primarily for himself and his wife, and he considers himself to be a moderate risk investor. Okay, go ahead, Josh. Hello, Josh, go ahead.
Thanks so much for taking my call, Troy. I love the show. My question is regarding Bombardier. The stock has been performing well, and the company has experienced significant delays. With that being said, they appear to have a strength with the government behind them. Is
Right.
this the right time for me to jump in? I'll hang up and await your answer.
Okay, thanks for the call, Josh.
I'll take this question. I've actually done a significant amount of research on this company, and I think you should definitely stay away. As you've noticed, Josh, Bombardier has not had any success in the past 5-year period, with an overall return of over the 5-year period of negative 78%. The TSX has outperformed Bombardier over the 5-year period with an overall return of negative 8%. Bombardier's financials on its balance sheet and its income statement are not pretty. Their net income has fell by an average of 208% per year over the last 3 years. This shows Bombardier's inability to control costs. Bombardier has received a bailout of $1 billion from the Quebec government last year and is seeking another $1 billion from the federal government, which shows their lack of capital. Government support is not guaranteed in the future. Even though this stock appears to be extremely cheap, it is also extremely risky. The standard deviation on the daily average return is 2.8, meaning it's highly volatile. You could lose a significant amount on your investment with short duration. There's no sign of any good news coming from the company that would result in a significant turnaround in the future. Therefore, this stock should be avoided as there are better options for investors in the market. Thanks for the question, Josh.
All right, at this point we have time for one more caller. This is Jim Beam from Kentucky. He is a machinist, and he believes in investing in the natural resources. Go ahead, Jim.
Howdy, fellas. I'm looking to make a quick buck. Tell me about Suncor. Should I invest or go to the casino? Thank y'all.
Okay, interesting question from our caller. Who can answer Jim's question?
Suncor.
Hey Jim, oil prices directly impact Suncor's financial success. With the price of oil falling almost 50% in Suncor's 2015 fiscal year, this had a direct impact on its growth and profitability ratios. In 2015, Suncor's revenue fell from about 26.7% from 2014, and its net income fell by 44.2%. Suncor had also had negative return on assets and return on equity of 2.5% and 5.1% respectively.
And let me just chime in here, Liam. So considering recent oil price fluctuations and decline, the company has fared well against its competitors. They have a clean balance sheet and a current ratio ranging from 1.3 to 1.7 in the years of 2013 to 2015, and has also maintained a debt-to-equity ratio below 1 in the last 3 years. That's very respectable. They have also been able to make cheap acquisitions of competitors affected by oil prices. The recent acquisition of Canada Oil Sands Limited will increase shareholder value for the long term.
You know what? Those are some great points, guys. You know what? Investors still might be scared because they've had negative 18% average returns over the last 5 years. But you know what? We think this could be a great time for investors to get in. Suncor's correlation with the TSX is 0.7%. So that means it's almost going up with the TSX at a 1-to-1 rate. We predict that the TSX is going to have a strong 2016. So you know what, Jim? Go in.
Okay, guys, as always, thanks for tuning into the Lucas News Network. This is Troy. We loved having you. Jolt, great guys. We hope to see you all soon. Thanks for coming on the show. We wish you all the best, okay? Take care. Good night.